At our strategy, we frame macro cycles through phased probabilities rather than predictions. We focus on sequencing risk instead of calling tops or bottoms. The objective is to stay liquid, flexible, and never forced into decisions. This conversation argues that major cycles rarely end cleanly. More often, they resolve through debt devaluation and currency repricing. The path matters more than the headline outcome. We are reviewing Anthony Fatsis on the What the Finance podcast with macro strategist Lyn Alden. The discussion centers on fiscal dominance, headline-driven markets, and the importance of monetary plumbing. We strongly recommend watching the full original discussion for context. Markets have shifted from trend-driven liquidity to headline-driven volatility. Political and geopolitical shocks now move prices faster and more frequently. This changes how risk needs to be managed, even if the underlying liquidity regime still exists. Fiscal policy now constrains monetary policy. Large deficits require ongoing market support. As issuance rises, plumbing stress increases, and intervention becomes reactive rather than optional. This means policy responds to system stress, not ideal economic conditions. Repo markets and treasury auctions increasingly drive real policy decisions. Even small disruptions can force large responses. When plumbing stress appears, inflation targets often become secondary, which makes liquidity support more likely during instability. Policy rates can fall while long-term yields remain elevated. Refinancing pressure can persist despite easing signals. Term premium can tighten financial conditions even when central banks appear more accommodative, making duration exposure highly conditional. Credit stress acts as the accelerator late in the cycle. Private credit increases refinancing sensitivity. Tighter credit feeds labor stress and cash flow pressure, which is often how slow macro stress turns into forced liquidity events. Historically, sustained inflation requires energy pressure. Without energy shocks, inflation tends to remain uneven. If energy scarcity emerges, it can overwhelm technology-driven disinflation and shift the inflation regime quickly. This is educational macro commentary only. It is not financial advice or a prediction. The first impact tends to fall on payment-sensitive households, especially housing affordability. Next come credit-dependent companies with leveraged balance sheets. Eventually, narrow equity leadership becomes vulnerable if liquidity stalls. We maintain liquidity buffers to avoid forced decisions. We monitor labor trends, credit stress, yield behavior, market plumbing, dollar funding conditions, and equity breadth. Risk is sized in tranches, not single convictions. Near-term probabilities favor policy delay rather than resolution. Medium-term risk of forced adjustment remains elevated. Long-term outcomes suggest a larger reset once delay mechanisms fail. Shorter horizons tend to favor persistence over clearing. Longer horizons increase the probability of reset and repricing. The change in probabilities matters more than the absolute numbers. Headline volatility is now structural under fiscal dominance. Incremental liquidity support appears more likely than abrupt shifts. Tail risks feel more plausible, even if they remain uncertain. We still require confirmation before reacting aggressively. We still avoid calendar certainty. Optionality remains more important than conviction. This is an environment where unlikely outcomes become plausible. Our edge is preparation, sequencing, and patience. We do not need to be early, but we cannot afford to be forced. Source attribution is Anthony Fatsis with Lyn Alden on the What the Finance podcast.